So, you ready?
Ready.
All right. I used to do a podcast with my brother.
Yeah.
As you know, for like a bunch of years, we were doing tech podcast stuff. And we would start every single episode, or he would start with saying, "Hey, are we live now? Are we live?" And I'm like, "We are." That was like pretty much every single thing. And he knew it we were live because he'd see the recording button,
Yeah.
and then we'd do it. And I think we kept that for a long time. Anyway, so anyways, there's always that like, so are we live?
Are we live?
Yeah, are we live now?
Are we on?
Yeah. And with that, I want to say welcome to the Furlo Capital podcast, where we are talking about investing in real estate. And our mission is to help people to invest wisely in both property and residence so that together we can build wealth while helping communities. And in this conversation, our goal is to help make those concrete and real. And so I've got my lovely bride and wife here, Jessi. Welcome.
Thank you.
Yeah,
Happy to be here.
It is good for you to be here. It's fun because it feels like in some way you are back in the business with me.
It's kind of true, a little bit.
Yeah, because we started together in 2009, and we did everything
together.
Yeah, it was great. Like the
We
late
tour
night
properties,
remodels.
fix stuff.
Yeah,
look
even
at numbers.
screen attendants. Like, we would
Screen
talk together.
attendants. Yeah.
Yeah, and since then, as the business has grown,
Refreshing
and
captain.
oh, dude,
Yes.
yes,
That's another podcast episode.
Oh, dude. I have the scar. I ended up going to the ER on that one. And then you finished the project
story.
while I was on the couch, just zoned out.
Yep.
And I think, if I remember correctly, I had just turned 30. And for me, that was the moment of, I am no longer invincible.
Ooh.
I get it. And I felt my own finiteness in that particular project, which in some ways was very depressing. But that's okay. You know,
right.
They got done. We have since sold that property, and it turned out pretty well. So it's all good. But yeah, so we are here, and I'm excited to be having these conversations with you. Depending on the order of things, this may be the first podcast that gets published. Maybe not. It's hard to tell because the last one we talked about was something that was like happening in real time. And we decided, I don't know if that's the best thing to publish right away. So we might flip-flop them.
Which is all right.
That's all good.
We're getting it started.
Yes. And we are not only getting the podcast started, but we are starting a new year, 2024. And I don't know about you, but that's a time when a lot of people start thinking about, well, what's going to happen next year? And I follow the real estate space fairly carefully, mostly because I just thoroughly enjoy it. Mm-hmm. I have a hunch you don't as much.
I do vicariously through you.
Yeah, and which is what we're going to do right here.
Give me all the updates.
Yeah, so I want to talk about a few things, like forward-looking things in the economy, just from a market standpoint. And I think that's helpful to anyone who is looking to passively invest or invest in general, just to have an idea for where things are going.
This is like specifically related to real estate.
Yes. Okay. Yeah.
Not just like, I mean, I don't know.
What other options do we potentially have?
Economics in general, or like other investment, like real, like stock market investments, or I don't know.
Yeah, when I did the podcast with my brother, we would always talk about what do we think different tech companies will come out with from a product standpoint.
Sure.
And we'd always talk about like, here's what I think the new iPhone feature will be, or here's at least what I want it to be.
Yeah.
Yeah, it was super fun.
The New Year episode.
Yeah. This will be real estate focused.
Related. Yeah.
Yeah. And so
commercial,
there's always
residential, all of it.
All of it, I guess, but probably mostly focused on commercial because multifamily properties land in that commercial space from a market standpoint.
Sure. Ooh.
And so, that's right. And so, that's what I want to talk about today. Nice. And just kind of give you some of my thoughts on where I think things are headed. And I'll be honest, like, nobody knows.
Sure.
At the end of the day, it has been a weird few years.
No.
Really? Yeah, it felt like in 2019 things were going okay, but it also felt like there was this looming, like things had been going really well for a long time. Like so, 2009 happened.
Yes.
And real estate prices continued to decline all the way through 2012. And then they kind of slingshotted into the other direction and were super high walking into 2019. And I know that there were a few people who were like, man, this doesn't seem sustainable. Are we in a bubble? I don't know. We're just looking for some sort of catalyst to take the economy off its path. And March 2020 came along, and there was a massive dip, and everyone's question was, from an economic and real estate standpoint, is the shape of it a V? Is it going to go down really hard and then just yo-yo back up? Is it going to be more like a U, where it goes down, stays down for a while, and then comes naturally back up? Or is it going to be more like an L, where it's gone down and it just and now it goes back to the old trajectory, but at that lower level? And it's like a level reset, essentially.
Okay.
Turned out to be a V at the end of the day. And I think most people
is it like an uneven V? Like values were here and it went down and now they're like...
Yes. Values shot up crazy amounts.
Ridiculous.
And when you think about it from a supply and demand standpoint, that makes a ton of sense. So everyone shuts down. And so goods stop getting made, stop getting shipped, stop getting on the stores. And so supply just goes way down. At the same time, because people weren't working, our government handed out checks. And so now suddenly everyone had a few $1,000s extra to spend. And so the demand goes way up. And so you got this crazy combination of supply is down, which usually means prices rise, and demand is up, which usually means prices rise. And so when you combine those two, it's like prices really rise. And we saw that with 9% inflation. I think it was last year, the year before. And so like it's just and which is highly predictable given those two dynamics that happen.
But it took a little bit for that to happen.
There's always a lag with that kind of stuff. Yeah, there definitely is.
Because if people like were not working in 2020, maybe even through 2021, and now it's almost 3 years later, it's still kind of cycling.
Inflation is no longer at that crazy high level anymore, but it's still high relative to what it has been historically the last decade or so.
Sure.
And so
it's not doing this anymore, like continuing to go up.
Well,
but it's just reset at a new level.
The rate is lower. Inflation is still happening. So like historically, inflation was happening at like 2-ish% a year. And so every year prices were going up 2%. And then there was a point in time where inflation was at 9%. And so everything was going up at 9%. That's that new level. And so now it has gone down to like 3.5%. So it's still like more than what we want it to be, but it's not nearly as bad. But you got to remember, it's like, if you look at inflation from an absolute standpoint, it was prices were always rising a little bit. They rose a lot in a very rapid amount, and now they're still rising. So the price
is not going to come down.
The price does not come down.
But the rate has slowed down.
Correct.
It won't go up as fast.
Yes, correct. Now, what's also interesting...
That's not great.
This
is why we don't talk about economics.
Inflation is a potential wealth killer. It's pretty bad. Unless you're highly leveraged and you have a lot of mortgages, then it makes all those mortgages worth less. So let's say you've got a loan for $100,000, and in today's dollars, I don't know, that $100,000, you could buy 100,000 McDonald's hamburgers.
Sure.
I don't know, I'm trying to make my math easy here.
All right.
But in the future, McDonald's raises their prices, and let's just say it's no longer $1, it's $1.50 now.
Okay.
Right?
Yeah.
It's a lot more. Now you can only buy 75,000 hamburgers with it. And so the value of that money is now a lot less. And so that $100,000 mortgage is now, quote, cheaper relative to the dollars that it would normally take to buy a cheeseburger or whatever.
Yeah.
Yeah, I did not explain that one.
A weird way to think about it. But
essentially it makes if it requires more money to buy everything, and this thing that you owe money on stays flat, that's good for you in the long run. Another way to think about it is we bought this house a few years ago, and we had a mortgage on it, and it's $1,300 a month, PITI, which at the time we're like, oh my gosh, that's so much. And now there's people who are renting from us across the street who are paying almost double what our mortgage is for their rent.
It's crazy.
And that just shows you that's because inflation has happened, values have gone up, but our debt has stayed flat. And so relative to them, now ours is a steal of a deal. And that's happening with all of our rental portfolio. So inflation is bad. Unless you're highly leveraged, then it's not the worst thing ever. Yeah, assuming you can still pay all your bills.
Okay, cool.
Yeah, so the question really, like, that everyone always wants to know is, so what's going to happen with prices? Are they going to go up or are they going to go down next year? Getting back to our actual original topic here.
Sure.
And honestly, like, no one knows, because, like I said, things happened in 2020, and then since then, it's kind of been this roller coaster ride. Prices shot up so much at the end of 2020 and in 21, and the beginning part of 22. Mm-hmm. People were just like, oh my gosh, like, I don't know. Like, this is insane.
Yeah.
And the affordability index is this measurement that they do. It's a ratio of the average price of a home and the average income. And as a general rule, like, that affordability likes to hover around 2. So the price of a home is 2x what your income is, as a general rule.
So, like, the house that you would be able to afford?
No, just the houses that are available on the market. So it's average home sale price, divided by average wages. Okay. So it would say, like, if it's normally at 2, if the average wage is $100,000, that means the average home is $200,000. Okay. That's kind of the idea. Well, it is currently sitting at like 5 or 6. Yeah. So home prices are like way more than.
So if the average income or wages are $100,000, the average home price is $500,000 currently?
Yeah, $500,000 to $600,000.
Okay.
Yep.
Yikes.
Which honestly feels right. I know you haven't been following it much, but like when you look at home prices, what people are paying, like, oh my gosh, yeah. Like, just small example, we bought this place 7 years ago, and we paid $250 for our home. Yeah. And we know that our parents bought a place like across the street. It's not as big. It's not as good. It was a massive fixer-upper.
Yep.
And they paid over $400,000 for that one. And that
was
was
like 2 years
6.
Later?
And what was that? I guess that would be 5 years after we bought ours.
Okay.
Right. So, like, that's just an example of where prices and that was like, and I know they've gone up since then, like the average home in this area have literally doubled on us. And so that's where you can start to do that math where you go, we were at the 2x because that was kind of where the right ratio for us. And now it's a lot closer to that 4x time period, just in this neighborhood alone. So you can already see that.
So
what does that mean for prices in the future?
Well, yeah. And moving forward, I mean, the market has to shift because people can't afford that based on their income. So they're going to stop buying. So demand is going to go down?
Potentially. But here's something that has frustrated everyone. Because typically, yes, that's what would happen. You actually wouldn't see prices go down. You would see them stay flat until inflation caught up. That's typically what you see happen. Or they fall a little bit. They never crash back down. They just kind of level out until that demand gets back to that 2-ish range.
So
is typically what you see happen.
Incomes would go up?
Yeah. Typically over time. Here's the other problem.
But they don't go up that fast. It doesn't seem like they do.
Well, because there's affordable home stuff, they might. It potentially. And these things do take time. Or you do see a crash, which is like what we saw in 2009.
Because people can't pay their mortgage.
But here's the problem. The thing that is really throwing everything off is interest rates are significantly higher today than they were just a few years ago. Because interest rates are higher now relatively to how they have been the last few years, people don't want to sell their house because they're like, I don't want to get rid of this great interest rate. I mean, you and I, we're never looking to sell, but we would definitely have that conversation. We'd be like, dude, our interest rate's like 2 and change. Like, it's amazing. It would take a lot for us to move and refinance. And we're not alone. All sorts of people are doing that. And so as a result, the supply on the market is really, really low. So even though the demand is now much lower because homes are not as affordable, the supply is also lower because they have these awesome interest rates.
Yeah.
And so will we see prices drop relative to affordability? I don't know. Probably not, honestly. That's my guess.
So it just is like a standstill in the market.
I think so, yeah. Yeah, it's a very weird dynamic that we haven't seen. Yeah. And there's another one that is going on. And this is probably, to me, one of the most interesting measures that we have in our economy. Because the other thing that economists keep arguing about is whether or not we will have, quote, a soft landing, a hard landing, a crash, that kind of stuff. So, again, the Fed drastically raised rates last year, which led to interest rates also rising over time. And part of it saying inflation's a killer, we need to kill inflation, and the only way that they can kill inflation is by increasing the interest rate. It makes people want to stop investing, and so you stop investing, you stop hiring people, you stop buying stuff, therefore you cut off the demand side of the equation, and in theory prices go back down. The Fed has never successfully done a soft landing where they get that timing just right.
Yeah, that seems really
it's super hard, and part of it is
it's not like a static.
Oh, it's not static.
And
there's a lag. There's all sorts of stuff that make it incredibly hard.
People are irrational.
And so as of right now, I kid you not, I have listened to 2 podcasts today only where they have been like, oh, maybe they pulled it off. I don't know. Or like, whereas like the week prior, they're like, no way, they didn't do it. It's going down in flames. Like, what? Dude. So,
nobody knows.
For the record, nobody knows. But there is one metric that so far has been the most predictive at figuring out if we're going to go into a recession or not. And it's a super interesting measure. It is essentially when you look at the spread between 2 different interest rate or yield curves. So investors can buy bonds, for example, and you can buy one that's a long term, pays out over the long time, or you can buy one that pays out over the short term. And there's different risk involved in both the long and the short term.
Sure.
And what you can do is you can measure the spread between those two, and that gives you an idea how confident are investors of the future. So if we think things are going to be great going forward, that 10-year bond yield is nice and high because things are going to be great. So they're willing to, like, the rate for it goes up. If they are concerned about the future and it's not going to be going well, it goes down. And it can actually go down below the short-term yield rate. There's a bunch of math.
Setting that?
Investors. It's all based on supply and demand. So essentially, the way a bond works, it's going to hurt your head. I'm sorry. So essentially, you have, let's say I have a bond, and I say, or a piece of paper, an investment, right? And I go, hey, this thing pays out 10% interest, right? And let's just say that there's a ton of people who go, oh man, 10%, right? 10% sounds great. You're like, I'm in, yeah. And I go, oh my gosh, there's a lot of demand for this. That's awesome. So then that means I can charge you more for my investment. It always pays out at 10%, but that investment that I make you pay for it goes, like, I can change the amount that you have to pay for it based on the demand. And so if it's high demand, that means you have to pay a lot for it, which means, if you have to pay $100 for getting $10 back, you're like, so that 10% is a derivative of, like, okay, I'm not explaining it well. Let me back up a second. So I've got an investment here, and I go, this piece of paper, if you buy it from me, will pay you $10. How much are you willing to pay for this piece of paper? That will eventually give you $10, let's say, over the next $10 every year for the next 10 years. You might say, hey, I'm willing to pay you $100 for it, right? And you go, okay, cool. That's whatever. That is a 10% return on the investment.
Sure.
I think, yeah. But maybe if there's a ton of people, I go, oh man, this thing's super valuable. It's now $20, which drops that rate down to 5%, right? And so that's essentially how bonds are priced. It's all based on supply and demand. There are all these fixed outputs that they're paying for it.
I think I get it.
Yeah. So it's inverse of what you think of you want it to be. Here's the important part is you can measure these things. Okay, you can measure, here's what the rates are for 10-year bonds, here's what the rates are for, say, 2-year bonds, and then you can compare the two.
Okay.
And that's the important part. And I wanted to print this off to make sure that I got this right. And so that is, like I said, it's called the yield spread. And
you can do that same thing with real estate investments? Is that what you're talking about?
No, I am literally talking about, like, bonds right now. Like,
but that's an indicator for
the economy in general, and I'm going to get there.
Okay.
So it says here, let me make sure I get this right. Usually that yield curve that I'm talking about, comparing the two, like, you can take the 10-year and you can minus the 2-year, and that spread tells you how things are going to be. So it says, usually the yield curve slopes upward, reflecting the fact that holders of long-term debt have taken on more risk. Okay, so it's slightly different than what I was saying. So it's saying that when it slopes up, it's saying good times, like in the short term, times are going to be good. And so you get, so it's saying if you're going to wait until the longer, it's riskier to wait because we know times are going to be good now. But if you think times are going to be bad now, then that means, in the future, I think, like, future might be bad, but I don't think it's going to be as bad as it is today.
Okay.
It's a way of seeing when things will go bad. Does that make sense? I'm going to pause, make sure you...
Not really. I'm visual, though, so maybe it would help if I looked at the picture.
Yeah, I've got something I want to show you, but I want to make sure you understand what you're looking at first before I show it to you.
Can you use a different analogy?
Yeah, all right. Let me think here. I'm trying to think through, like, what would... let's say we're playing a game, okay? A card game. Let's say it's poker. I don't know. And you've got a certain amount of money that you're willing to bet, okay? And you can do your current hand, or you can do a future hand.
Okay.
All right?
Yeah.
We're good?
Yeah.
So, if you think you've got a good current hand, would you bet a lot or a little?
A lot.
All right. Awesome. If you've got a bad hand, would you bet a lot now or maybe wait until a future hand?
Wait. Just see if I get something better.
So that's the exact same thing. So what this spread is looking at is saying there are long-term bets being made and there are short-term bets, current hands bets being made. And so if the current hand is going way up, that means that you're willing to pay more for it because you think you have a good hand now, right? But if you think things are going to be bad currently because you have a bad hand, you're not going to pay very much at all, and you're going to you got to put your money somewhere. So you say, I'm going to bet on a future deal. Okay. Yeah. All right. Now let's go all the way back to that initial discussion where I've got these things that are paying out money, right? And so the more you pay for something in general, does your return on investment go down or up?
Up.
The more so the return, like the amount of money it pays out is always exactly the same. So if you pay more for it, does your return go up or down?
Down, because because it's the same.
So that's so we're not betting on hands, or maybe let's say we are betting on poker hands, but these are like, each of these cards are going to pay you $1, right? They all have a fixed output. And so if you say, I think I have a good hand, I'm willing to pay more for it, does your return go up or down? And it's the inverse of what you...
Up.
No. It's the inverse. If you pay more for something, the return goes down.
Oh, sorry, I don't understand.
All right, your output is always the same. I will always pay you $100. Always. Okay? We are playing a poker hand. I will always pay you $100. Okay? Does that make sense?
That part makes sense.
If you pay more to play the game, will your return be more or less?
No, it's less.
Okay. All right.
Because the difference between what I paid you
and what you get
smaller.
back, that's slower interest rate.
Yeah.
Bonds work exactly the same way. They always pay a fixed output. And so if you pay more for that fixed output,
you're going to get less back.
Correct. And if you pay less for it, and that is measured by the interest rate.
Okay.
Okay?
Okay.
Does that make sense?
Yes.
So if something has a high interest rate, it means it's cheap because not a lot of people are willing to pay for it. And if it has a low interest rate, it means it's really expensive and therefore high in demand. Okay?
Which is,
I know, it's
opposite.
It's inverse of how you would think about it, but it's all because the payment is fixed.
It's the same.
So that number is always the same, so therefore these two things are...
weird, but...
I know, it totally hurts my head to think about it. Okay, so if in the short term you think you have a good hand, that means you're willing to pay a lot for it, which means that interest rate's going to be really low, right? Because people are going to pay more for it. Which means conversely, on the far end, that, again, same output, that means that interest rate is going to be relatively high because not a lot of people are paying for it. So what you normally see is it's a positive delta where the 10-year is higher than the 2-year, which means people think in the short term, things will be good today. And we don't know about the long term, but maybe they're not going to be as good as they are today. And if they're relatively flat, that means they're going to be about the same. Now, here's where things get interesting. Sometimes they invert, where it goes, what they call it's an inverted yield curve, where people think right now is a bad hand. It's not going to be good in the short term. And so we're going to put all of our investment and money in the long term, which means the short term rate goes up and the long term rate goes down, which means that if it's this one minus this one, you now have a negative number. Okay? We are currently negative right now. I'm going to show you this chart, and I want you to describe it to me. Okay? So that people who aren't looking at it can see it. So this is that math over time. Okay, so it starts back in 1980, and it goes all the way past 2020. So it was
negative in around 1980.
Correct. Then it went back up to positive. It was negative again around
1990.
Yep, and then negative again.
2000. So every 10 years,
Ish.
It goes negative.
Yeah. And so this is that measurement that shows like when it goes negative. When people think, when investors who study this stuff, who think about it all the time, say, you know what? Things are going to be worse in the short term than they are in the long term. Okay? Now, scoot all the way over to here. What's something you notice about?
It's negative right now.
Yeah, and like by a lot.
Yeah.
Right? If you compare it to, now the 1980s, it looks like it was crazy time, is what it looks like. Also an era of massive high inflation. Interesting. And interest rates, I think, went up to like, they were over 12%, 18% in some cases. It was nuts. Oil embargo, all that stuff went down during the 80s. Okay, there's one more feature of this chart here. Do you see these gray bars? Every single one of those are official recessions.
Ooh.
Now, do you notice something about what happens? When do those gray bars happen?
After it's negative.
Yeah. So the curves invert, they go negative, and then when, within reason, when they go positive again, that is when a recession hits.
Oh.
So today we are negative. Which means if history repeats itself, which so far in the last few years it's done it 1, 2, 3, 4, 5 times. The last 6. The last 6 times it is inverted, it has triggered a recession. That to me, I go, I know it's a pretty high probability worth looking at. So now the question is, when is that going to stop inverting? Will that happen?
Well, I mean, if you look at history, it looks like maybe 1 to 2 years ish. Maybe 3. And so this has been 1, 2, 3.
Yeah, it's already been longer than normal.
Yeah.
A lot of people, including myself, thought that it was going to uninvert the second half of this year, of 2023.
Well, it looks like it was going up, but then it dropped again. Which some of these other patterns do that same thing. It looks like it goes up, then it goes down, then it goes up. Yeah, there's a little. It looks like a W almost in most of them.
Yeah,
or squished
and
W.
This one's got a few. Yeah. So I don't know, and you could obviously look at each individual curve and try to predict those individually, and then do the subtraction, and that might tell you.
Okay, so let me make sure I'm wrapping my head around what this actually means. If this percent yield goes positive again, that means people are going to want to buy or bet now because it's going to be good.
Usually, yes. And that's usually what that trigger is right now everyone's being cautious and careful, so we're okay.
We're waiting.
Yeah, and it's the second people stop being cautious and careful, that's when you get hit.
There's a problem.
Yeah.
Interesting. And that's what triggers the recession.
Yeah. You know, it doesn't last forever, but definitely. So this is what's so interesting about where we're at in this economy. You've got this measure here, which is crazy predictable on predicting next recessions. Now, in here, it doesn't say how bad they are. And you can even see in the 2020, like that was a month, maybe 2, where it was that V, right? And it popped right back up.
Well, the interest rate didn't go negative.
Correct. It touched the line,
maybe?
which is what got everyone like, oh my gosh. I mean, it was just barely negative. And it still did it, just barely.
Yeah.
And so that's part of our like, okay, does the depth of it indicate how big of a deal it is? Right here, it doesn't seem to, because this one's really deep but doesn't last that long. And maybe it's all about how long that it's negative for matters, because back in the 80s, that was like negative for a while and like had a really brief up and then had a really long, relatively speaking, long time. That's again what happened in the 2009, 2010 era. So I don't know. It's a really, so, and again, I had kind of this at the beginning.
But also like in 2009, 2008, 9 is when we started investing and buying places. So which is just before the recession.
Well, we did it just as it started.
Because okay, yeah, here's 2010. Okay, so 2009. So, like, when this goes back up and it's a recession, that is good for buyers.
Correct. And that is why I have moved out of maintenance mode into getting investors and buying mode, because I think, and what I have said is there are going to be some good deals in 2023. Yeah. I think there's going to be some fantastic deals in 2024 and probably 2025 as well. There's multiple reasons for it, but this is one of those reasons.
Interesting.
That you look at and go, oh, we are potentially sitting on the precipice. Now, having said that, interest rates are very different relative to how they've been for a long time. Supply and demand, just in general, is very different than it has been for a long time. There's an election cycle coming up, which throws things like crazy.
Yeah, that would be interesting to layer over this, like other world events and other.
Yeah, there are currently 2 wars going on across the world.
Right.
That I don't, so there are a lot of pieces here that make it really hard to predict. What I do know is for us, the focus is let's find assets that need some sort of work. That you can force the value into it by putting in the work. And the hope is that the economy is wind in the sails instead of a headwind. Yeah. And that's part of the look of saying, look, if we buy a place and we're going to take 5 years to turn it around, I'm pretty certain the economy will be turned around in 5 years. And so if I can buy it when things look all turmoil, we go heads down, we do our thing, do our work during that time. And then when it becomes a tailwind, we sell. Awesome. Cool. That's what I'm looking to do. And so that's, again, it's just kind of an interesting way of looking at the economy. They're all like, there's uncertainties. It's all kind of probabilities. If I were a betting person, I would say this curve is probably going to uninvert next year. I think there's going to be a lot of people who have to start to move just because life happens. You don't have a choice. And you start to get used to the fact that, like, interest rate 6%.
Just expensive.
Is what it is. Yeah. You think about all these people who are graduating college and getting into the market, they don't know what it was like to have a 3%. Like, that's not a thing for them. Yeah. And so they just go, this is it. This is what I can afford. And they just go for it. Yeah. And so I think the demand will continue to be, demand and supply will continue to kind of move and shift. And there are governments trying to do all sorts of stuff, like making it easier to build accessory dwelling units, just trying to increase the density, trying to make it easier, trying to make things more affordable. So there's a lot of moving pieces. There's one more fascinating thing before we call it for what was supposed to be a 10 to 15 minute talk is traditionally what you've seen with inflation, and this is like what happened in the 1980s, is it starts to go up, and so the Fed does step in, and they increase rates. Now, the Fed this time around, they've increased rates faster than it has ever happened before. It's kind of incredible.
Increased rates of what?
The federal funds rate, which plays a factor into what the overall interest rates are that you can get on loans and mortgages. It's not directly that, but it's close to it. It's complicated. Don't worry about it. But they increased rates in an attempt to try to slow down inflation, and they've done it the faster than has ever been done in history. Now, in the 1980s, they also raised it. Inflation looked like it was starting to taper off, and in an attempt to do the soft landing, they backed off the raises, even lowered rates some, which everyone got all excited. Yay, rates are lowered. I've been sitting on the sidelines, but now I'm ready to get back in. So imagine, rates lower a little bit. You've got all these people who couldn't buy because the interest rate put them out. Now they jump back in. Demand increases. What happens to prices when demand increases?
They go up.
Yeah. And so that's what happened in the 80s. Inflation skyrocketed. It was like a bullwhip crack effect. It went up a little bit. It went up a significant amount, went down a little bit, and then it skyrocketed up, and that was when interest rates had to get double digits, like really high, in order to tamp it back down, and things were a problem. Our Fed has already stopped raising rates, and they have already signaled that they plan to lower them a couple of times next year. So there is a not so small probability that that same bullwhip effect happens
Demand's
again.
Skyrocket.
Demand skyrockets, and we all go, everything's fine, it's great. Inflation takes off like a rocket. They have to react. Interest rates go back up, and that is what craters the economy. And we see it in the second half of next year. We go, oh, here's that recession that all the doomsayers have been telling us about. It's finally here. And everyone's also going to go, yeah, they're broken clocks, like they're right twice a day. It was about time, like it was going to happen. And so they don't get credit for it. And so it's just interesting. And so, again, for us, I think the strategy stays the same. Let's find good, valuable assets because we're in it for the semi-long haul. And I think there's going to be some interesting opportunities to pop up in the next year as a result of this. And so, yeah, that's what I'm seeing.
All right.
Oh,
awesome.
Get your economy fixed for the year. You're good to go.
Yep, I'm good. I would not call myself an economist at all.
I appreciate you slogging through. Interest rates are genuinely, and like yield bond rates are genuinely confusing.
Oh, it's absolutely
confusing. Even myself, like I think there was one time I had to dial back
how
to describe this.
I
got backwards on it. Yeah, it's so confusing.
Oh, it's super confusing.
Which, and that's why it's important to have a trusted advisor to help you out. Like us, and help you navigate these kind of things.
It's honestly why I made you make me that spreadsheet when we were starting, where I was like, can you just color code this? And if the box is green, it's a good deal, and if it's red, it's a bad deal. Yeah. Like that's just what we need for the economy.
Yeah, well,
like, are we green or are we red?
I wish it was that easy. That's hard work too. Like for some people, it is absolutely green. It's awesome. It's amazing. And for others, it's red. It's horrible. It's the end. And so that's the other what makes this so hard. It's not. There isn't one economy. There are millions of economies, and it honestly gets broken up by household. And like if you imagine, like if you're someone who's in the tech industry who recently got let go, like it's bad. The economy's horrible. But there's other people who are like, oh man, this is great. Like I love it. Things are fine.
Sure.
So yeah, it just makes it complicated. And hopefully you found that valuable as well. And if you did, we would love it if you would like and review our show on however you listen to your podcast. And so just thanks so much, and have a great day.